This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Time series analysis. And what time series analysis is, it's a forecasting exercise. For instance, sales. Very commonly, when we're preparing budgets and so on, a company will want to try and forecast what the future sales will be. And one thing they're likely to do is look to see what the past sales were. That if we could draw a graph of the past sales, maybe if it's a nice smooth pattern, we can use that to forecast into the future. And in an ideal world, suppose I did a graph of the sales over time. Perhaps we recorded the sales every quarter, every 3 months. And in an ideal world, you'd stick them on a graph and find a lovely smooth pattern. And of course, if there was a nice smooth pattern, these were the last 5, 6 quarters or 3-month periods, then perhaps we could use that to forecast into the future. But of course, that's unlikely to be such a nice smooth pattern for several reasons. And you'll see on the first page, it talks about variations in the observations. That one reason is what we call cyclical variations. That if you looked over a long period, you do tend to find, as economies get better and then go through a bit of a recession, that perhaps you get something like this. That maybe sales were increasing nicely for a few years, then they start to go down, then they start to go up again. That's cyclical, and that's much more what you might call a long-term variation. Most economies have booms when things are going well, I don't know, maybe 10 years, and then they hit a recession, and maybe 10 years things go badly, and so on. But that's long-term. What we're much more interested in what we're about to do, is what we call seasonal variations. If you look back at my first picture, I said that would be the ideal situation. But a lot of things are seasonal. For instance, if you're selling ice cream, you're likely to sell more in the summer and less in the winter, depending whether you're in the northern hemisphere or the southern hemisphere. Or again, umbrellas. It's seasonal. And so what's likely to happen is, even if there's an underlying smooth pattern, you'll find, perhaps if it sells every 3 months, that some months, some quarters, 3-month periods, are higher, some lower. And you have this sort of pattern. Again, ice cream, it's always up on average in summer, it's always down on average in winter. That sort of pattern, which we call a seasonal variation. Now, this is much more short-term, and what we're going to do, or what you're expected to be able to do, is, having got that sort of pattern, to be able to identify what the underlying pattern is. It does appear here to be the average, if you like, going up quite smoothly, and we call that the trend. The trend is this underlying pattern. Perhaps I'll do it in a different colour to make it clear. And so we're going to try and identify the trend, and that perhaps we could forecast into the future. But we're also going to try and measure what we call the seasonal variations. That, some quarters it's always up on average. Other quarters it's always down on average. And if we want to use this for forecasting into the future, well, if the trend is reasonably smooth, we could forecast that. And if we've identified these seasonal variations, perhaps we can forecast that as well. That, in summer we'll forecast a bit more than the average, in winter a bit less. So that's the terminology. These are seasonal variations. The page does mention random or residual variations. Of course, nothing's going to be perfect. However smooth the underlying pattern may be, the trend. However, we might be able to measure seasonal variations. Again, and things are always going to be a bit different, and we can't do anything about that. These random variations, we can't predict them. Anyway, to show you how we do the arithmetic, have a look at the next page where you've got example 1. And it says, set out below are the sales per quarter in thousands of units of a company over the last 3 years. A quarter is 3 months. So you can see in the year 2000, the sales were 80 in the first quarter, up to 87 in the second, down to 82 in the third, up to 90 in the fourth, and so on in 2001, 2002. And you can see that overall sales are going up. You know, it's 80 at the beginning, by the final quarter it's 116, so sales are increasing. But you can see at a glance there is an element of seasonality. Quarter 2, there's always a big jump. In the first year, 80 up to 87. The second year, 90 up to 95. The third year, 105 up to 112. But when we move to the third quarter, it always goes down a bit. 87 down to 82, 95 down to 93, 112 down to 103. So there does appear to be some seasonality there. And again, what we're going to try and do is identify what the underlying pattern is, the trend, if it wasn't for this seasonal business, and separately try and measure the degree of seasonality. How much higher or lower are we in each quarter than the trend, the average? And so let's have a go. It says identify the trend, calculate the average seasonal variation. First of all, let's write them all down. In 2000, quarter 1 was 80, quarter 2 was 87, quarter 3 was 82, quarter 4 was 90. Moving on to 2001, quarter 1 was 90, 95, 93, and 102. And in the third year, quarter 1 was 105, quarter 2, 112, quarter 3, 103, quarter 4, 116. The first thing we want to do is try and smooth out the pattern. Try and estimate what the sales would be each quarter if it wasn't going up, down, up, down. And the way we do that is we say, well, the seasonality is over a year, over 4 quarters. And so let's, for that first year, work out what the average sales per quarter are over those 12 months. And so the average, as usual, add them up and divide by 4. So 80 plus 87 plus 82 plus 90. Divide by 4. I get 84.75. And I've put that right in the middle. Because if there wasn't seasonality, it does appear sales are going up each quarter. So throughout those 12 months, the trend, some will be lower than average, some will be higher. That 84 is sort of bang in the middle of the year. And let's take the next 12-month period. And by the next 12-month period, I mean from the beginning of quarter 2 to quarter 1 of the following year. Again, it's 12 months. 1, 2, 3, 4 quarters. And let's work out the average for those. So 87 plus 82 plus 90 plus 90. Divide by 4. I get 87.25. And again, I put that right in the middle of that 12-month period. And so on. We keep taking successive 12-month averages. So the next 12-month period is from here to here. Again, we've got 4 quarters, average them. 82 plus 90 plus 90 plus 95, divide by 4, 89.25. Again, right in the middle of those. Well, I don't need to keep on talking, but we keep taking 12-month, 4-quarter averages. So the next one is which? It's from here to here. 90 plus 90 plus 95 plus 93, divide by 4 is 92. The next one, there to there. 90 plus 95 plus 93 plus 102 divided by 4 is 95. That can't be right. Oh, yes, it can. Next one is here to here. 95 plus 93 plus 102 plus 105. I get 98.75. Nearly there. Next one is here to here. 93 plus 102 plus 105 plus 112 divided by 4 is 103. Next one is there to there. 102 plus 105 plus 112 plus 103. 105.5. And finally, the last 4. 105 plus 112 plus 103 plus 116. 109. So I hope you saw what I was doing there. Successive 4 quarters. We've worked out the average, and that has smoothed it out because we've looked at the average over each 12 months. The seasonal variation has disappeared, and it does appear to be growing reasonably smoothly. Now, those figures there we call a 4-quarter moving average. A moving average, I think for fairly obvious reasons. However, we are going to need to do one more step because I know what the actual sales were in each quarter, 80, 87, 82. What I'd really like to know is what would the sales be each quarter if there was no seasonality, and then we could compare. But the trouble is, that 84.75, for example, doesn't coincide with any one of the 4 quarters. That's right in the middle of the year. It's 3 months in the middle of the year, which is sort of a bit of quarter 2 and a bit of quarter 3. And so to be able to have something we could compare with the actual sales in a quarter, we need to average them again. You see, if I take the average of those two, 84.75 plus 87.25 divided by 2, I get 86. Well, if you think about it, that coincides with quarter 3. Because that first average was part quarter 2, part quarter 3. The next average was part quarter 3, part quarter 4. By averaging them, I can now say, the actual sales in quarter 3 were 82. If there hadn't been this seasonality, it would have been 86. And we keep doing that. For similar reasons, we then take those two. And we say, what's the average? 87.25 plus 89.25 divided by 2. 88.25. And again, that coincides with quarter 4. Shortly, I can compare them. And so let me carry on doing that for all of them. The next one is those two. 89.25 plus 92 divided by 2 is 90.62, or 63, doesn't matter which way we round. The next two, 92.95, gives me 93.5. The next two, 95 plus 98.75, 96.88. The next two, 98.75 plus 103, 100.88. 103 plus 105.5 divided by 2, 104.25. And finally, 105.5 plus 109 divided by 2, 107.25. And so what we've done there, we've taken those averages, and so now from quarter 3 onwards, I'm going to be able in a minute to compare what actually happened, 82, with what would have happened if there was no seasonality, 86. And so that third column we call the centered average. Or the trend. And we could forecast the trend. There's no special way. I mean, you could put them on a graph and you'd find it was a much smoother pattern, and then extend it, by hand. Or you could use regression analysis from the previous chapter. If it was reasonably linear, use regression in exactly the same way as we did in, I think it was chapter 19. So there's the trend, and we could forecast that into the future. But also, we can forecast or measure the seasonal variation. Let's look at the seasonal variation in each case. Let's look quarter by quarter and see how much higher or lower we were than the trend. We'll take the actual figure minus the trend. Now the first two quarters we've nothing to compare with, so we can't do anything. But quarter 3, the actual was 82, the trend was 86. So we were minus 4 from the trend. Quarter 4, we were 90s against 88.25. So we were up 1.75. Quarter 1, 90s against 90.63. We're down 0.63. Next one, 95 and 93.5. We're up 1.5. The next one, we're down 3.88. Next one, we're up 102 minus 100.88. We're at 1.12. Quarter 1, we're up 0.75. And finally, quarter 2, 112 minus 107.25. We're up 4.75. Now, all right, we've only looking at a short period here, but look what's happened. Quarter 3 is down 4. It's down 388. So it just seems to be seasonality. Quarter 3 always seems to be down. Quarter 4 is up 1.75. Quarter 4 is up 1.12. So quarter 4 always seems to be up. Quarter 1 down 0.63, up 0.75. So quarter 3 is more or less on trend. Quarter 1, sorry. Quarter 2 up 1.5, up 4. Quarter 2 always seems to be up. Now it's not perfect, obviously. They're not up and down exactly the same amounts. But if we want to forecast the seasonal variation, well, let's work out the average. So let's work out the average seasonal variation with 4 quarters. In 2000, well, with nothing for the first 2, but quarters 3 and 4. Quarter 3 was down 4, and quarter 4 was up 1.75. Minus 4, up 1.75. In 2001, minus 0.63 plus 1.5 minus 3.88 plus 1.12. And finally 2002, up 0.75, up 4.75. But again, the last 2 quarters with nothing to compare with. So having listed the variations for each quarter, let's work out the average. And the average, add them up and divide by 2. So quarter 1, it was minus 0.63 plus 0.75, divided by 2 is plus 0.06. Quarter 2, what's the average variation in quarter 2? Plus 1.5 plus 4.75 divided by 2, plus 3.13. Quarter 4, minus 4 minus 3.88 divided by 2. The average is minus 3.94. And finally, quarter 4, 1.75, 1.12. The average is plus 1.44. All right, one final thing here, which I always think is a tiny bit silly, but still. What should those add up to? You know, some quarters are higher, some quarters are lower. Have I got those right, incidentally? 3.94. Yes, they seem to be. Yes, some quarters higher, some quarters lower. But because there are differences from an average, they should in fact add up to 0. And what do they add up to? I've got plus 0.06 plus 3.13 minus 3.94 plus 1.44. They actually add up to plus 0.69. Now I said they should add up to 0 because the differences from averages. The reason they don't add up to 0 is because the first 2 quarters and the last 2 were used in calculating the averages, but then we couldn't actually compare them with anything to get a seasonal variation. And that's why they won't add up to precisely 0. Certainly if we looked at 10 years, the effect would be so tiny it would add up to virtually 0, but here of course it doesn't. And so what some people do, and be aware just in case it was tested, is they say, well, let's make them add up to 0. To add up to 0, we're going to have to subtract 0.69. And so let's subtract a little bit from each of them. There's 4 quarters, so 0.69 divided by 4. Let's subtract 0.17. 0.17. 0.17 and I think 0.18. Do they add up? Yes, they do. By subtracting a bit of rounding there, but an equal amount from each, they should now add up to 0. So 0.06 minus 0.17 is minus 0.11. 3.13 minus 0.17 is 2.96. 3.94 minus 3.94 minus 0.17. Oh. is minus 4.11. And finally, quarter 4, 1.44 minus 0.18, 1.26. And do they add up to 0? Minus 0.11 plus 2.96 minus 4.11 plus 1.26. Yes, they do. And so what will we do for forecasting? What we do is forecast the trend so there's the underlying pattern. And as I say, to forecast, there's no rule. You could just put them on a graph and try and extend it. Or as I said before, if it appeared to be, when we put them on a graph, if it was more or less linear, then you could use regression and forecast using that. But having forecast the trend, you would then adjust by the relevant seasonal variation. So if, for instance, you were forecasting quarter 3 of next year, you'd forecast the trend, but then you'd reduce it by 4.11, because we know quarter 3 is always down on average, whereas we're at quarter 2, we know that's always up on average. So there we are. A lovely little exercise. I say there we are, except for just one thing. What we've just done, working out the seasonal variation as the difference between the actual sales and the trend, is called the additive model. And that's fine, except, surely, if sales are increasing, then would you not expect over time that the seasonal variations would increase as well? I mean, here the increases aren't so big, so I'm not too worried. But, if you looked at several years and the sales were sort of, by the end, were 10 times what they were at the beginning, surely it'd be quite likely that the seasonal variations were 10 times as big as well. And so the alternative method when we look at the seasonal variations is something called the multiplicative model. And rather than just look at seasonal variations as a difference, actual minus trend, we go through and work out actual as a percent of trend. And so let's run through and see what I mean. So again, we can't do anything for quarters 1 and 2, but quarter 3, the actual was 82, the trend was 86, so 82 over 86 as a percent is 95.35%. So we can't mess it. Similarly, quarter 4, 90 as a percent of the trend of 88.25. 90 divided by 88.25 is 101.98%. And so on. I won't show all the workings, I shouldn't need. But the next one, 90 as a percent of 90.63 is 99.30%. 95 as a percent of 93.5 is 101.6%. 93 on 96.88 is 95.99 is 96%. 102 on 100.88 is 101.11%. Nearly there. 105 on 104.25, 100.72%. And finally, 112 divided by 107.25, 104.43%. So I hope you see what I'm doing. The actual as a percent of trend. And then just like before, we can calculate the average percent, the average seasonality for each quarter. So if I set up the table again, but this time in percents, I might as well use the same table, if you'll forgive me. Here we go. What were nothing for the first two quarters of 2000. For the next two, 95.35, 101.98. The next year, 99.3, 101.6, 96, 101.11, and the final year, 100.72, 104.43, nothing for the last two quarters. And so, just like before, what's the average percent for each quarter? Well, quarter one, 99.3 plus 100.72 divided by 2 is 100.01. Quarter two, 101.6, 104.43, 103.02. The next one, 91.35 plus 96 divided by 2, 93.68. And finally, quarter four, 101.98 plus 101.11 divided by 2, 101.55%. Again, something I always think of as a bit silly, but what should these add up to? This time, this shouldn't add up to 0. Surely, some quarters is more than 100%, some quarters a bit less than 100%. This should add up to 400%. And what is the total here? 100.01 plus 103.02, 93.68, 101.55. They actually add up to 398.26. Well, again, this should add up in an ideal world to 400. And so we need to increase them all a little bit. We need an extra 400 minus 398.26. We need an extra 1.74%. Well, if we add a quarter of that to each of them, then they will add up to 400. So 1.74 divided by 4 will increase them by 0.43, 0.43, 0.44, 0.44. The rounding, we don't want to go to more than 2 places. But what would we end up with? Remember, we're increasing them all. So quarter one will take 100.44, quarter two, 103.45, quarter three, 93.68 plus 0.44, 94.12, and finally 101.99. And do they add up to 400? Yes, they do. And how will we apply that? Well, again, we'll forecast the trend, but this time, instead of adding or subtracting the variation, as we did when it was the additive model, will then multiply by the relevant seasonal variation. And there we are. All right, so there's quite a lot of arithmetic involved there, far too much for just a 2-mark multiple choice question. And in the exam, you won't be doing an entire question, it's just not feasible. But any bit of that you could be examined on, so obviously I needed to go through a full one. Anyway, there we are, that's moving averages, additive, multiplicative.